Hello, my name is Todd Dolshaw with Elevated Retirement Solutions. Today I am doing a recording to summarize our first ever Wealth Accelerator series. And a lot of clients and people reach out to me asking them just in a recording after the fact. So I wanted to make sure that I did that in regards to the main talking points and know that I'm going to be hosting these events on a monthly basis. So feel free to simply shoot me an email or keep an eye out for RSVPs as they come up in your inbox. Okay, so obviously the markets this year have been really all over the place. Start off really high with a lot of excitement, followed by a lot of panic once trade tariffs started to go into effect. And trade tariffs essentially are taxes, all things being equal, that corporations pay that import services and goods from the rest of the world. Unfortunately, with this, that has really slowed down growth projections and made it very, very difficult for businesses and countries to do forecasting given the on and off again trade tariff policy. It's kind of like a sports official changing the rules constantly. Imagine somebody shooting a three-pointer in basketball, the ref saying after the fact, nope, that is only worth 2 points. Then next time they come down the court and they say, oh, that's worth 4 points. Now, needless to say, that would put the players at a standstill because they wouldn't know what the rules are each time they come down the court. And that's a perfect metaphor for exactly what's going on right now with the trade tariffs on and off again, as well as just the general upheaval that's coming out of Washington right now. And the market hates uncertainty, and boy, there's certainly a lot of it right now. So that's why we're seeing a massive sell-off in both stocks and bonds where they go down one day, come back up the next. But the pure, really way to assess the market, at least from my perspective, is A, how expensive is the market? And then what are the growth prospects of those companies that we're investing in for ownership? The second one is much harder to calculate. So we'll start with the first, and then we'll talk about that. So sharing my screen here, what we're going to be looking at is the S&P 500. So the S&P 500 naturally is a large index that pretty much most people know. Largest 500 companies based in the United States, where the largest companies such as Apple are given a much higher weighting in this, whereas much smaller companies aren't. So looking at this, price to earnings ratio is the key metric that we're looking at on the bottom here, as well as the overall price of the S&P 500 over time. And as you can see, has done very well. Hasn't been certainly a straight line. 2018 was a really rough year. 2020, of course, during COVID. 2022, and both stocks and bonds sold off over double digits. And since then has had a nice recovery up until this year of 2025 when it sold off a lot, especially in April. So what you're looking at the bottom here is the 10-year average price per earnings ratio of the S&P 500. And what this says is over the last 10 years on average, you have to pay $24.58 to get one earnings per share. So think about that like price per gallon when you go to fill up the pump, price per gallon of milk, so on and so forth. When things are really cheap, that's the time to buy and invest more aggressively, at least in my opinion, such as 2022, when things are lower, so that when they go back up above over their averages like they did last year, that's a good time to get more conservative. And that's exactly what I did for my clients when we look at broader financial planning, which I'm going to talk about here in a second. So all things being equal, even though at this point in time the market has recovered a decent amount here in May, it's still significantly above its historical average, which is why it's a good time to be very prudent and look at your combination of stocks, bonds, cash, alternatives, and other asset classes to make sure that you're reverse engineering your investments to fit your plan and when you're going to need your money, not the other way around. And the best way to do that, at least in my opinion, is to use Monte Carlo software. And that's exactly what we're going to be talking through today here. So starting out with a sample case here, we have a test client, male 55 years old, makes a good income as a business owner, 200,000 of income that he's reporting as W-2, and then kicks out another 30,000 of K1s to himself through the business. We'll get into pros and cons of strategies like this in the future, but at least that gives us a good starting place. Now, when it comes to their goals, this is really the most important part, of course, of investments in financial planning, right? It's why are we even talking and what do you want for yourself? So this client and this sample case made up wants to retire in 10 years, live off of $10,000 per month in today's dollars. I'm going to assume this inflates at 2.5%. Healthcare inflates at 5.4, which is what Medicare is. $5,400 a year roughly is the national average. And they want to travel, spend $10,000 a year traveling without having to live on a shoestring budget. From that perspective, the first place we usually start, of course, is looking at their net worth and their investments. And that's besides the scope of this discussion as relates to today. But what I'm really going to hammer down and focus on is their risk tolerance, as well as what the potential growth is for this. So you can see here, they want to be very aggressive based upon their overall investments, which makes sense. Business owners typically are more aggressive and confident in nature and could potentially generate a higher return. The downside with the higher return creates more risk. So if we saw another recession like we did back in 2008, with that peak, of course, from top to bottom, you'd be looking at somebody who currently has 1.7 million of investments going top to bottom, losing potentially $680,000. So a big part of what I do as a financial planner and wealth manager, first and foremost, is helping clients make sure that we don't go very aggressive at the peak of the market when prices are significantly above their averages, which is exactly what we did last year when I took everybody more conservative. And B, when things do go down and sell off like they have this year, boy, that's the time to put more money into the market when things are cheaper, right? Imagine, going back to our visual here, if we thought about this like going to the grocery store when we've got some coupons to burn, imagine putting lots of money in the stock market when things are really cheap, and then seeing the recovery in 2023 and 24. Phenomenal returns thereafter, historically speaking. But with this, what this says is in order for this client to achieve their goals, our software is projecting on average with an 82% stock mixture and the rest in bonds and cash and alternatives. We're projecting a modest 6.66% rate of return given the very high growth that we saw in 2023 and 2024, which is probably prudent given where we're at right now with all the instability at this point in time. Now, jumping to the results, now we're going to talk about different ways to invest this. And what I have is 3 different scenarios, all of which will show whether they're on track or not based upon their financial goals. It says here in the current scenario, this is someone that I personally have allocated their investments with more cash, more conservative heading into this year without getting into the weeds. And they're sitting at a 74% probability of success in order to achieve their goals for retirement, all things being equal. If we were to do the traditional growth-based investment strategy, where we put 80% into stocks, 20% into bonds, then you can actually see the probability of success drops to 69%. And we're going to talk about why. And then moderate, if we went 60-40, 60% in the stocks, 40% in bonds roughly, then the probability goes a little bit higher to 73, but it's not as high as a customized portfolio that I built at 74% here. And we're going to talk about what makes up that difference. And it's all about the trade-off between the average return and standard deviation, which is a measurement of risk. So what this says here with my customized portfolio that I built straight from my strategies, we're projecting a modest 6% rate of return that they need in order to achieve their financial goals, which when I'm sitting down and looking with my clients, going through the reports year over year, this is the KPI or key performance metric that we use to manage their investments as well as their financial plans. So in years where we do significantly more than 6.08% like we did last year, that's the time to take some profits, take some extra cash and put that towards debt reduction and or building up your reserves so that then we can pounce when things are cheap like they are this year. Standard deviation is a measurement of risk. So this says 2/3 of the time, the returns are going to be within 13% roughly of the 6% average rate of return. So it'll be significantly higher, significantly lower, more often than not. But all things being equal, you want standard deviation to be lower because that brings down the probability that you're going to have really bad sell-offs in the market, especially when you're retired. And you can see here in the traditional perspective, if we go more aggressive, well then, yes, our return goes a little bit higher at 6.66%, but the standard deviation jumps up to 15.5, which really makes that a much more riskier proposition, which is why during bad recessions and downturns in the market, all of which Monte Carlo factors in with complicated math and probability modeling, the returns in the plan actually goes down, even with a higher projected straight line rate of return because of that risk reward trade-off. And then conversely, if they went the other direction and went with a traditional 60-40 stock bond mix, the returns actually would be less, even with a lower standard deviation. So the returns look less in terms of the overall financial plans. So all things being equal, combination of looking at what's going on with the markets and the economy, how expensive it is the stock market and the other investments that we're looking at. And if we start first with your plan, back into the numbers of whatever return we're trying to achieve, then at that point, we can pick the most optimal plan for you based upon your situation. And no, of course, this is just a test case scenario. I'm not recommending people do this in their own situation until they talk to a financial advisor, such as myself, and do their own research and due diligence. So thank you so much for tuning in, and I really appreciate your time here today.